Hello friends, our video today is on how to start a trading desk. Now with world markets right now in a state of turmoil due to the sanctions imposed by the United States, I think this might be a good time to look back and see the mistakes made during the last bull run and the subsequent, I should say semi-crash which has happened, and prepare for the future so that you could make trading into a career for the long term. Now, I would like to begin by first of all pointing out the fact that too many people out there take trading to be a very easy and simple job. It is not. It takes 8 years to become a doctor. It takes years of experience to rise to any commendable position in any company. And you expect to learn trading in 2 minutes. That doesn't happen. It doesn't work that way. You have to study the subject of trading. And trading is something which cannot be taught. Technical analysis can be taught. The methods of trading can be taught. But trading itself is a personalized activity which depends purely on the individual. Now, to think that somebody can teach you trading is like thinking that by reading a book on dieting, you can lose weight. You cannot do that. You have to have time and experience. Now, I'm going to begin today's exposition on how to start a trading desk by first looking at this slideshow, which is starting with the Dunning-Kruger curve. The Dunning-Kruger curve essentially explains to you how low knowledge and low experience gives you a false sense of confidence, right? Taking you to the peak of Mount Stupid. These are all figurative terms, followed by a crash. Now, this is not a monetary crash, it's a confidence crash. Remember, we are plotting confidence versus wisdom. And then gradually over time, as you gain knowledge and wisdom, knowledge and experience, in other words, wisdom, your confidence gradually rises to the same level as it was when you were totally ignorant of what you were doing. However, this time you have reached the valley of despair, scoped the slope of enlightenment, and ultimately reached the plateau of sustainability, giving you a much higher level of confidence in whatever you're doing. The same holds for every aspect of life. But nowhere does it hold more than in our markets, where a lot of people come into the market thinking that the market is just a game. It's so simple, just buy and sell higher. It is, everybody is a genius in a bull run. But it is when the markets reverse and the majority of the crowd is on the wrong side of the market that you begin to realize that it's not all fun and games. So today we are going to go through these steps which I personally feel are important for a person to understand how to set up your own trading desk. Now, some of these are variable. Some of the steps which I'm going to go into are variable, and you may alter the numbers according to your convenience. But by and large, I would request you to stick to these numbers. And overall, there will be certain factors used in this video, which will be explained in detail in later videos. So take it one step at a time. Do not try to master the entire knowledge. Experience, of course, is going to take a long time. Experience is a lifelong process, right? But the amount of knowledge which is to be acquired takes a certain amount of time. Give it that time. Trust me, it's the biggest investment you'll be making in the market. Now, let's begin with what is your net worth. Now, the net worth N may be defined in very crude terms as the total amount of money which you have if you dispose of everything which you have excepting the house which you live in, because that is one of the most essential things in your life. So the net worth is something which you sit down and calculate that if I sell off all my jewelry, all my bonds, stocks, all the excess land and buildings which I have, and my car, what is the amount of money which I have? The amount of money which you will then count as your trading capital will have to be 10% of N. Now, why 10%? You may use 50% if you want to. You may use 20% if you want to. My suggestion to you of 10% is that because trading is a high risk and high return business, 10% of your entire net worth is disposable. even if all of it is lost due to a million reasons, right? Black swan events or an act of God, you can recover this 10% over a short period of time so as not to disturb the life of your family and yourself. So once you've calculated your net worth, calculate 10% of your net worth, liquidate that by selling maybe some assets, put that amount into a bank account, and then one of the most difficult things to do in trading, write off that amount immediately. Now, I have been in association with a lot of fund managers, with a lot of people who trade, and some of them have told me that this statement, write it off immediately, is probably one of the key to successes in the market. If you come with any baggage in the market, if you've come into the market to pay your children's fees or to pay your grocery bills or to accumulate money for the purpose of your daughter's wedding, and you are using trading as a tool, which is different from investment. Investment is a long-term entry which is passive and which lasts for years on end. Trading is a short-term activity lasting from a single day to a few days. There is a difference between the two. So you may invest much more than 10% of your net worth, but no more than 10% of your net worth should be used as a trading capital for trading. Now, how do we begin the act of trading? Please remember that despite the hundreds of people who tell you that they have trading systems which work 100%, there is no such thing as 100% in this market. Anything and everything associated with technical analysis will fail at some time. So you may use scanners like Patterns, which is freely available at https://thepatternSite.com, run by one of the persons whom I greatly respect, Tom Bulkowski. It is a scanner which can scan and take out shares which are available for short to medium term trading. Now, there are scanners available in almost all softwares like Metastock, like AmiBroker, like TradingView.com, and so on, which satisfy criteria of a trading tool. Now, you have to decide on trading systems. This is a topic which we shall be discussing in the coming lectures. And then look for confluences using analytical tools. Please remember that a trading tool is a black and white indicator. It tells you crystal clear that this is the point to enter and this is a likely stop loss. This is what a trading tool does. Some trading tools, which are continuation trading tools, also take out targets. But generally, targets are taken out by other methods like Fibonacci retracement and so on. Trading tools are high probability tools, very high probability tools. They become even higher probability when combined with analytical tools. Analytical tools are tools which are present in technical analysis for the purpose of consolidating or confluencing or giving support to trading tools. So trading tools include things like candlestick reversal patterns, which are very well defined, gaps, chart patterns, Bollinger Band breakouts, etc. All these will be discussed in various other videos which I will be putting up. Analytical tools include things like trend lines, Fibonacci levels, moving averages, etc. Now, once you have determined that this is the share which I want to trade, and this is the direction in which I want to trade, because the direction can only be twofold. You either buy or you sell. Now, if you buy, you're expecting the share to move higher. If you sell, you're expecting the share to move lower. In the case of a buy, the stop loss will be below the buying rate. In case of a short sell, the stop loss will be above the buying rate. However, the technical tools itself, plus there are other parameters. In fact, very shortly, I will be putting up a video on the various kinds of stop losses which are there in technical analysis. Besides that, there is always a maximum stop loss. The maximum stop loss is monetary in nature. It is basically 2% of your trading capital. Now, let's take an example. Supposing that you determine your net worth is 1 crore of rupees. What is your trading capital? 10% of your net worth which is 10 lakhs. So 10 lakhs is what you liquidate and put into a bank account, because brokers, the NSE, don't accept assets other than money as a collateral or as a payment. You cannot give your bonds, or you cannot give your property papers as a collateral. Now, if 2% of T is then 20,000 rupees. Now, please remember that this is not going to be calculated on an EMI kind of a basis, that if you lost 2%, then it becomes 2% of 9,80,000. 2% of T is always 20,000 if your net worth was 1 crore. Therefore, the number of continuous wrong trades required to wipe out your trading capital is 50. Now, what is the probability that you are going to make 50 wrong trades after having studied a powerful subject like technical analysis, after having gained knowledge and wisdom over a period of time, that you will wipe out your trading capital? Very unlikely. Therefore, these parameters are extremely important to remember and use. Now, once you have determined that your maximum stop loss is, let's say, 20,000 rupees, then based on the initial stop loss. Now, what is the initial stop loss? When you enter into a trade, let's say you enter into a buy trade, the stop loss has to be below the buy trade, the entry level. Now, normally that is given by the trading tool itself. However, so that is why it is called a chartical stop loss. However, there are other stop losses, of which one is very important, which is a volatility based stop loss based on something called the average true range. Now, the maximum of these two is used as the initial stop loss. So once I divide the maximum amount of money which I'm willing to risk in a trade by the initial stop loss. So let's say the initial stop loss was 10 rupees, all right, and the amount of money which I'm willing to lose in a single trade is 20,000 rupees. I automatically arrive at my position sizing, which is 20,000 divided by 10, which is 2,000 shares. So please do not think that you can randomly go into the market with 10 lakhs of rupees and trade any quantity. If you wish to survive, and trust me, survival is key to making money in this market, then position sizing is a very, very important aspect of the entire process. Now, given that you have determined the exact trade which you wish to do, the position size, now you must put it through the filter of the risk reward ratio. There are various methodologies of calculating targets, like Fibonacci levels, like previous peaks and troughs, which again we will be discussing in depth in a future video. But the risk reward ratio must be at least 1:2. But in my opinion, it should even be 1:3 for all trades. But 1:2 is the minimum which you should have for a swing trade. In intraday trades, where you may be compelled to square out the trade at the end of the day, you may even go down to a break-even level of 1:1, or maybe even 1:<1 if you have to cut at the end of the day. Now, the portfolio heat is the total amount of the trading capital which you risk at any point in time. My suggestion and recommendation for the portfolio heat is that it should not exceed 6% of the trading capital. Now, because 2% is what you are risking in a single trade, at any point in time, a trader should have no more than 3 active trades in the market. Because if the markets go against you, there will be no place to run if you have 15 different trades. And the color of the money which you make in one trade is identical to the color of the money which you make in any other trade. A 500 rupee note made in Nifty is the same as the 500 rupee note made in Tata Steel. Therefore, no more than 3 trades. So you have to be choosy. There are selection methods by which you can take out the 3 highest probability trades at any point in time. And if you find a trade which is higher probability than one of your existing trades, then you must square off an earlier trade before entering into a new trade. The 266 method of trading is probably the most effective way to make money in the market. What is the 266 way? 266 essentially stands for 2% maximum stop loss, 6% is the portfolio heat, and 6% is your potential target, giving you a risk reward of 1:3. Now, Once you start trading, which again, as I'm going on and on telling you, nobody can teach you how to trade. Out of the hundreds of people who are telling you that they have got systems which will give you 100% guarantee, nobody can teach you how to trade. Trading depends a lot on your wisdom, on your emotional quotient, on your wealth management, on your responsibility, on your ability to tackle emergencies in the market. Reading a chart is like reading a map. Trading in the market is like driving a car. They're not the same. You come across a pothole. Technical analysis doesn't tell you what to do. Your ability to handle that crisis at that point in time is what is going to distinguish you from a bad to a mediocre trader as compared to a good trader. So pyramiding is when you start making profits. Please remember that at any point in time, if you randomly trade, right, 50% statistically of your trade should go right. That doesn't work that way. But with increasing knowledge, increasing confidence in trading tools, and increasing discipline, it is expected that you will be able to increase your profits in the market. Now, once you accomplish reaching 20% of your trading capital, then half of that money, let's say in our example, that's 2 lakhs of rupees. 1 lakh of rupees goes into a fixed deposit or it goes out to the market. The remaining 1 lakh you use it to be put back into your trading capital, increasing your trading capital from 10 lakhs to 11 lakhs. Increasing T will automatically increment all the values we have studied till now, and you will begin to grow. That is how you grow your account, by making profits and plowing them back into the trading capital. Now, finally, if there is a 20% loss or profit, now if there's a 20% loss, then it's quite a big hit. Stop trading for a week. Things are not working out for you. Perhaps you should take a step back, relax, maybe even go out for a week and stop trading. If you make 20% profit, then the confidence level, the feeling that you are invincible in the market, may cause you to step out of the discipline which you have inculcated for yourself over such a long time, by increasing your trades, by making you overconfident. The same holds for 50%, but in this case, it's 2 weeks. Now, maintain a meticulous record of each trade. This is very, very important. Keeping a record, when every business out there, factories, shopkeepers, they keep a record of what they have done. Do not think that trading is a frivolous game. It is a mind game which requires tremendous amount of discipline. And the discipline includes money management, it includes emotional control, it includes the responsibility to trade every trade which your system throws up. Now, also remember a few other factors. Do not trade your opinion of the market, trade the charts. Also, do not get emotional in the market. All easy things to say, but they will take you years of experience to master. Markets can remain irrational for long periods of time. Successful trading is episodic and not continuous. Do not think that by going on hitting trades, you're working the whole day. Good traders put their trades into the market and sit back and watch their trades, which will either get stopped out or will give them a good profit. When we talk about episodic, which means related to episodes, it means that your trading systems must generate clear-cut, trading tool based, analytical tool confirmed trades. Do not trade randomly in the market. Technical analysis is your weapon in the market. Discipline is your armor in the market. Discipline saves you from getting massacred in the market. Technical analysis helps you to get more and more winning trades. Now with that, friends, we end this session. I hope I've given you a fair idea of how to begin your own personalized trading desk. In the long run, you will have to adjust these parameters which I've given you according to your personal likes and dislikes. But by and large, I hope that this session has been useful to you. Many of the factors mentioned in this video, like trading tools, analytical tools, stop losses, targets, will be covered in depth in the coming videos, and we hope that you stay with us, watch those videos, and profit in the markets. Please remember, the markets are treacherous. There, every time you trade in the markets, the probability of a loss is high. Do not get taken in by people who are telling you that they have 100% accurate system. There is no such thing like that. There are only high probability of success systems and mediocre systems. But what makes the difference between success and failure in the market is not the system, but you as a trader. Please keep that in mind, and we look forward to seeing you in our future videos. Thank you. Have a great week, and let's hope that we meet again soon.